Alright guys, so welcome back. So this course is going to teach you how to make use of the market structure you just learned how to map in the part 1, okay, of market structure video on this channel. The part 1 was created before this one. This one is a part 2. Now you have learned how to map the structure in different time frames and multi time frames at the same time. Now it's time to learn how to use it to get your bias. And right here, what we have for today's teaching plan is market bias, daily bias, and draw on liquidity. So market bias is basically what the market currently is doing. So if the market is long term on a bullish bias, if the market is going up like this, it's called market bias. Okay, as long as that pair is bullish, most of the time frames of that pair is bullish. The current market bias is bullish. But listen, the fact that the market is bullish long term, is creating higher highs, higher lows on the weekly time frame, on the daily time frame, doesn't mean every day you come to the market you should be buying. There are some days that are meant for retracement, and if you're caught buying those days, you lose money multiple times. And there are some days that are meant for the real buys. The daily bias I'm going to teach you here is going to teach you which days you should be buying, which days you should be selling according to the market bias. Okay, it's going to make you know when you come to the chart on every given day what you should be looking for. Okay, now we have what called the draw on liquidity here. That's DOL. Okay, so DOL is basically the destination where you're expecting price to go at every given time. Okay, so the truth is that on every time frame there is a DOL. Since DOL is destination, for instance, if you're on the 4-hour chart and we just took out a high and we just pull back to fair value gap, since the trend is bullish, we'll be expecting price to continue to this high. Therefore, this high is the draw on liquidity for that given time frame you're looking at. Okay, that's just it. So draw on liquidity can be found on both weekly, daily, 4 hours, every of these time frames where you try to understand the bias from. So basically, the easy way or the one word you can use to describe draw on liquidity is destination. Okay, so now let's move further to the bias types we have and how we can incorporate it in the market to know our daily bias. All right, so I bring you here the 3 bias types of each of the biases. So for instance, you need to get this really clear. We have 2 basic type of bias. We have bullish bias and we have bearish bias. Okay, the market is either going to be going up or it's going to be going down on every given day. So what you're about to learn is to know when you come to the market whether you should be expecting bulls or you should be expecting bears. That's what you're learning currently. So to be able to know if it's going to be bullish, you need the weekly bias to be bullish, you need the daily bias to be bullish, you need the 4 hours bias to be bullish. So if this is bullish, this is bullish, this is bullish, that day you can actively look for buy trades with your entry model. If weekly is bearish, daily is bearish, 4 hours is bearish, you have to actively look for sell trades that day. Now if weekly is bullish, daily is bearish, then 4 hours is bullish, it's all mixed up, no trade. They must all align. Now what you're about to learn are the 3 bullish bias types. So what does that mean is that these bullish bias types is divided into type 1, type 2, type 3. There are 3 different market structures you see. When you see them, you know for that particular time frame you're looking at, it's going to be a bullish bias for that time frame. Remember, our higher time frames are these 3: weekly, daily, 4 hours. Okay, so on the day you're going to buy, you either want the weekly to be in a type 1 bullish pattern, or a type 2 bullish pattern, or a type 3 bullish pattern. Basically, the 3 of them should share themselves among these 3 types for you to trust that the market is going to buy. Now that's exactly the same thing for bearish, but the inverse. Okay, so let's move on. So we have these three types. We have type A, we have type B, we have type C. So what does the type A mean, or how is it used? So the type A is basically when you are on a bullish trend on that particular time frame. You're on a bullish trend, and then price has created a verified high now. Okay, and then we have been able to pull back to an IRL. So IRLs are basically POIs. Don't get it twisted. That's internal range liquidity. So we have FVGs fall under this category, and we have OBs fall under this category, and we have even liquidity fall under this category. How does liquidity fall under this category? Well, we'll look at that right now. So of course, when you watched market structure in the advanced market structure course, if you're watching this on YouTube and the part 1 of this video, you knew that for a particular trend, for each time frame, let's assume this is a 4-hour time frame, and I use green lines to mark the break of structures, and any high that carries green is verified on the 15 minutes to have a chalk at this area. This has a 15 minutes chalk at this area. That's why it's actually verified. Now there will be times when these highs might not be verified, but it's going to look like a high, but it's not verified. And now price will pull back and then take out the high again. So what this means is, as long as here is not qualified to have a green high, here is not going to be qualified to have a green low. So automatically this becomes what? Just a mere liquidity pool. The protected low is this one. This protected low is this one. This protected low, because this led to price breaking a verified high. This is a strong low that led to price breaking a verified high, but this is not a strong low because it did not push price to break any high. This high is not verified. So here is a mere liquidity pool, and price can come back anytime, take out this and continue higher. Okay, right? But price cannot come down to this because this is protected, and if price ever does that, the market will shift bearish. Meaning if price ever comes down to take out this low, price has shifted bearish. But for price to continue going up, it can run some liquidity pools, but not these ones that pushed price to take out a verified high. Now this is regardless of time frames. It happens on the weekly, it happens on the 4 hours, it happens on the daily. Okay, so that's exactly what I mean, is that kind of liquidity pool is also part of IRL, internal range liquidity. So now, like I said, a bullish trend active, a verified high in that particular time frame. If this is a daily time frame, here was verified on the 4 hour because the 4 hour chalk happened. If this is a weekly time frame, here was verified on the daily time frame because daily chalk happened around here. Okay, now we pulled back right into this fair value gap, or this IRL, and then we are leaving. How do you use this? If you come to the chart at your trading time, so I come to the chart by 7 a.m. Eastern time to 11 a.m. Eastern time. That's my trading time. To 11 a.m. Eastern time. That's my trading time. The truth is, if I come to the chart, I want to see, if I see these things, then I know this is a type A bullish bias on that particular time frame I'm looking at, maybe the weekly or the daily or the 4 hour. This just these three. I know that this is a type A. I want to come and see it in this phase. But if I come and see it in this phase, a bearish trend, verified low, an IRL resting here, but price has not tapped into it, then therefore I know we have a bullish bias here, even if this is a bearish trend, because I will be expecting price to move towards this before we drop. So that move towards this is what I want to trade, because when I come to the chart, I want to complete the missing puzzle. Okay, I want to be able to complete the missing puzzle. That's it. Now here becomes a draw on liquidity, the destination I'm expecting price to go. In this case, here becomes the draw on liquidity, the destination I'm expecting price to go on that time frame. What about type C? The same thing. Type C is a situation whereby we are on a bullish trend. We just took out an old verified high or whatever, and then we are heading up, but we don't have a verified high there. we don't have this. This is not verified. So it's an impulsive move. Okay, in this case we call it type C, because where we are headed to, our draw is up, something very external, something very high up, either an inefficiency that has to be filled or an old high. Okay, in a type C, all I want to do is come and apply my entry model. I'm not going to be anticipating any pullbacks at all, because a pullback is not supposed to happen, because it has not shown. The chalk that happens at the lower time frame is a sign that price should retrace. If it does not happen, it means price is bullish and will continue higher. And for those of you that like asking yourselves, that's why when ERLs get taken out, not all the time price reverses. Sometimes it keeps going up because there has not been any confirmation around it. All right, so let's move to the bearish type. Now the same thing but inverted. We have the bearish type A, type B, and type C. This is when the trend is bearish. We create a verified low, and that's why I marked it, and we pulled back to an IRL, a POI, an FVG, an OB, any of this, and then we now have to drop from there back to this low. Did you see that? If I come to the chart and meet it this way, I'm bearish, and this is my draw. Okay, in any time frame at all among those three I listed: weekly, daily, 4 hours. Now the same thing here with the type B, bearish bias. It's a bullish trend, verified high on that time frame, but then we have an IRL resting here, so we need a bearish move. We need to complete the puzzle. As I came to the chart, I have to look for trades that will take me down to this important area, because here is a draw of liquidity now, the destination we're expecting price to go. The same thing with the type C, break or structure, but then no verified low here, no verified low here. So we are dropping lower to an external range liquidity that is very low, or an inefficiency that has to be filled, an old one, but we don't have a verified low here, so it's a free fall. I'll come to the chart and just apply my entry model. Now this is exactly what you need. Now, how do you get your daily bias? Now I've just explained the bias types. How do you get your daily bias? Well, you need your daily, sorry, you need your weekly, your daily, and 4 hours to be in sync. Meaning your weekly should be showing either this or this or this. Your daily should be showing either this or this or this. Your 4 hours should be showing either this or this or this at that given time you're in the market for you to look for buys. Now, if any of them is showing a bearish type and the other showing a bullish type, it's out of sync and you shouldn't be trading. So let's move to real life examples. Okay, so I would do this with trades I've taken in the past, so that you can see it working in real life, that this is what I use. So here we have USDCAD January 3rd 2025. As you can see, it's a win 2.5 hour. This is my entry time, this is my exit time. My emotions before neutral, emotions during a bit skeptical because the structure was kind of weird, but then emotions after neutral, and then that's it. Okay, now we have these screenshots that shows that I took the trade that day. These are the proofs that I took the trade. You can see now. Let's look at it. It says 3rd January USDCAD. So let's take a look at that. Right, 3rd January. Right, so 3rd January USDCAD, we have that right here. So guys, take a good look at that. Okay, take a good look at that. Right, so this is our weekly time frame, and I need you to pay attention to the black lines. Okay, and that's what you get the structure. See, when we mapped our structure in the previous course, which is advanced market structure, which is, if you're watching this on YouTube, that's a part 1 of this video. We marked all these monthly charts so that we can see through to mark out the weekly structures. Okay, and then the lower time frame structures, because without them you can't be able to just know what is right to mark. That's why there's a top-down analysis. So you have to pay attention to the black lines. So we have these, and then do you see we don't have any weekly high right now? You can see many highs here, red, green, but no black. We don't have any established or verified weekly high. So what does that mean? It means we are in a type C on the weekly time frame. Take a look at that. No verified high. We are headed up. We broke structure. That's what we have on the weekly time frame. That's cool. Now on the daily time frame, remember we are looking at this particular day, particular trade. That's what we're trying to look at, so pay attention. So on this particular day, this right now is supposed to be red. Currently this is a red high because it led to a 4-hour chop, which we'll see properly if we have the 4 hours. But as at this day, this was green. Okay, this high was green, not red. It was not qualified. Now let's take a look at that why. Now if you look at the, if you trace these 4-hour structures from here, we'll be having something like this here, right? And then we have this low, high, low. Then we have this high, and we have this low. So this low broke this high and led to this one we see right now. So we are in this daily range between this high and this low, and this was the day we traded. It was later on the next day that price pulled all the way back down and took out this low and turned here to red. Otherwise, here it's not supposed to red on this particular day. Okay, now you know. Now if you look at it from a daily perspective, it's a type C because that's not a red high, that's green. So if you want to mark the daily time frame, focus on the red. So we have gonna have these, then nothing else, no more highs. So this is type C again, right? Type C again. So now the 4-hour chart, what type is the 4-hour chart? Take a look at that. What type is the 4-hour chart? So the 4-hour chart is in a type A. Why? We did this low as at that time did this high. Now here is a fair value gap, a very big one at that, and as you can see, price got into it. Now as long as we remain in this fair value gap and we have not carried out the intent, which is either getting to this place or to this place, because if we carry out the intent by running this fair value gap, covering it completely to get here, the fair value gap becomes useless. If we enter it and then we get to this high, it becomes useless. But while we are in it, it's still useful. All you have to come to the chart and apply your entry model in discount arrays. But we're not talking about entry models right now, so we are only going to talk about bias. So on this particular day, I have this black line. That's January 3rd. Can you see my bias was bullish, and you can see how the day ended. And this was where I targeted as a take profit, and I took my profit and I left because we are seeing a consolidation. I did not hold to this place because we are still ranging. But you see the bulls, that was how I won that trade that day. Okay, that was how I won this trade that day. Now let's see another good example. Like I told you guys, I want to talk about my entry model. There are videos on the channel that talk about entry model. You can go and see them. And if you have your own, you can apply yours. But this is strictly on DOL daily bias structure. So the next example we're going to use is Euro USD on the 7th. Okay, that's my second trade, January, that I won for 2R. And here is the proof. Sorry. Here is the proof. Did you see that? I won that trade right there. So this is the proof. I took the trade. Okay, it's in my journal. So now we're going to see how it works. Euro USD. So now Euro USD on the 7th. Let's make use of another broker. This is the broker I used to trade my day-to-day trading. So let's use another broker, right? So weekly. So we have to figure out where 7th is first. Okay, I think this is it. Now if you pay good attention to my Euro USD structures, you have to focus on the blacks. So we have high, lows, high, lows, high, lows, high, low, this, and then we don't have any weekly high right here. And you might be like, but we have any weekly lows, sorry. We might be like, we can see weekly lows here. Well, we just can't. These are not weekly lows. If you verify them, you find out that they are not. And please, if you want to verify, don't start verifying from here. There are a lot of choppy price action here down to deceive you. So start verifying from these areas. Okay, from here, start keeping your verification, and you be very careful. If you verify it correctly, you find out that there are no weekly lows here. Okay, so now how do you now we have seen that we're in the type C. Sorry, we have seen that we're in the type C. We don't have any other weekly low here after this one. This was the last BOS we had on the weekly time frame, on the weekly structure. So we are on bearish type C this time. Look at it. We don't have any verified low. So it means we are bearish. So daily, where are we on the daily? time frame. So please, my structure and map with a lot of things. Pay attention to what we see here on the daily. Now this is when I took the trade, this black line. So we have not seen these areas. So what we have here is currently we have this and this. Verified high, yes, of course, this high is a strong high, took out the verified low, correct? But at this point, we don't have any daily low currently. We have only 4-hour lows. So what does that mean? That puts us on a type C, okay? That puts us on a type C for daily time frame. Take a good look at it. So I want to use my path tool and show you what I mean. This, see, no low. Again, it was here we had a low. Here, we had a low here, but before we took the trade, no lows. It's a green low. So that's a type C bearish also. So what about the 4 hours? So take a look at the 4 hours, right? As at this time, 7th January, we have a complete running 4-hour structure. Okay, so you see from here, if you want to track this, see low, we kept breaking structures to the downside. Now we had this low I refuse to mark. This is not a 4-hour low because it's not verified on the 15 minutes, and this is exactly why this structures changed. Immediately you make a mistake with this, you have changed the whole 4-hour structures and everything will become wrong. So this is not verified, but this is verified. So here's low, this is ignored. And the highest highs among all these highs is the one that's responsible for taking this, and that's this. And after the high, we retraced and started pulling back. And on the way we are pulling back, this became qualified to be green because a chalk happened along the line, if visible on the 15th. And then we retraced back to run a buy side liquidity. Now, this is the protected high. This is not a protected high. This is a random buy side. I explained this earlier about internal range liquidities. Buy side, this is a high that led to this low. We would flip bullish if price takes out this, but no, the market is still in a bearish sentiment as of this time. So we ran buy side, and when we ran it the previous day, 5th, 6th, and Monday, I knew we were gonna drop till this level. I posted it on my Telegram back then. Now let's see if I can find it. So you can see here on the January 7th, you can see the dates. You can see I posted the bias, sticking to my bearish bias on EU for now till I see reasons not to. If you look very well, you see me that I am already in a trade and I was aiming for these lows already. You can see it. This is 1 month ago literally, and this is me in the trade literally. So whatever I'm teaching you right here is exactly what I use. And if you're watching this video and it's kind of hard for you to assimilate, it means maybe you are part of those guys that cannot learn via YouTube videos. The mentorship is available, okay? So the mentorship, I'll teach you how to map structure correctly. Now, I'm not just teaching because it's more like a school, because when I teach you, I give you assignments, I give you something to work on, and you submit it back to me. And then I would look at what you worked on and correct you in a live class if possible. And if it's a very minor mistake, I can just correct you on the DMs with videos or pictures. But if it's something that needs serious correction, there will be a live class, right? You get corrected in a live class. I give you more assignments. I hold your hand till you are a professional at marking structure. Okay, that's the idea. If you don't know structure, you cannot know your bias. And if you want to use things like CRT or other candlestick prediction techniques, they are way harder and way more stressful. So now this is it. You can see how we dropped. I got my entry model, and this was where I was targeting, I think around here, but you see price kept dropping. The next day we dropped, the next day bearish. Now one thing is that once you've known that price is going here, you don't even need to look at the weekly or daily again. You know that we are heading here. Today you apply your entry model, apply your sell entry model today, you apply your sell entry model today on the lower time frames, the same thing till you get there. That's how simple it is. So let's look exactly at gold. This is the last example we're going to be having. All right, so I wanted to do another pair because I have lots of USDCAD and Euro USDs I trade, because I just trade 3 pairs. But I want to do gold so that you can see something else, a different structure altogether. So this is gold on the 23rd January 2025, and you need to see that I actually took the trade and I won the trade. Okay, so this is around the 5th, I think last week of January. So that's it. I have, so here we go. This is the trade. I took the trade, right? It's a bullish trade. So let's see how it is. 23rd of January for gold. All right, so here we have gold on the weekly time frame. Now take a look at this. So remember, you have to pay attention to the weekly lines, the black lines, right? Because there are a lot of lines here, but the weekly lines are marked with black. If you watch the part one, you get what I'm saying. So we have these, all the way from there. We got this, and then this, and then this. This is exactly how we were on the gold chart. All of these are red are just one swing for the gold structure. Okay, so now I need you to see something very important, right? So now this particular candle where we had that trade, that week we had that trade, we have not crossed this yet. So we are in that phase whereby we have created a verified high, which is black. We have pulled back to a fair value gap, okay, which is an IRL, and then we moving out of that, trading back to ERL. That's our draw on liquidity, okay, on weekly. So that's settled. What type of bias is that? That is type A. Do you see that? We're moving from here to here. That's what bullish type A. Good. So now let's see what the daily has to do. So what does the daily have? Take a look at this. So you see the structures on the daily. We have the red structures. Well, let's mark it up from here. We have new structures here. We have these, we have this, we have this, we have this, we have this, we have this. Now this line is exactly where I had my trade. So means this, we had my trade before price created the next verified high. Meaning as at my time when I took this trade, there was no red high right there. If you look closely, you see there's a green high. There's no red high. The red high happened later, okay? A day after. So it means we are in a type C, because on that particular day I took my trade, no verified daily high. So for the daily, we're on the type C. And that particular place we're headed to is this red, is this black high here, because on the type C, there must be something above we are chasing, which is the weekly high in this case. That's it. Break a structure, no verified high. We're going up. I always apply my entry model here. Okay. Now let's look at 4-hour time frame on that same date. What do we see? So the 4 hours bullish, do you see it? No, we have to focus on the green lines now. Very easy, right? So we have high, low, high, low, high, low, and this, right? So this was the exact day I took this trade. This gray area I marked. Take away my black lines so I can see things clearly. So this gray area is the day I took the trade, 23 December, 23rd December. And what happened? What bullish bias type do we have? We have the type A right here, and check, because we created a verified green line 4-hour high, and then we pulled back to fair value gap, which is the IRL in this case. And then here becomes our draw, because we trade towards this place. Now you can see the 3 time frames were in sync, all bullish types. Euro USD, all of them were all bearish types. That was exactly how I can have the confidence to apply my entry model. So you've seen it, that the whole entry model you learn, the ICT 2022 model, all those things, they are just a part. And this is the last example, and you've seen it as a proof that I took this trade. And if I go to my channel, you see it that I took this trade, and I told everybody that, hey, look at this trade. Let's see. January 23rd. This is 11th. You should be on this channel, guys. You should be on this channel. This channel, I post my draw liquidities, I post my wins, I post my losses. Every single thing I do, I post it. So I post my directional bias. You can just see where I'm anticipating price, and you can apply your entry model. This free channel will change your trading, because everything here is hyper educational, and you need things like, you don't need signals, guys. You don't need signals. You need education, and you need this as important as ever, right? So 23rd, this was my other gold trade I won. We're talking about 23rd, so let's see 23rd here. Let's see 23rd here. All right, right there, that's 23rd. This is FX broker. It's a bit different from Oanda as at that day. Okay, this is Oanda 23rd, and that is FX broker for gold. So I think that should be FXCM, the short form of FXCM. But you can see when I call the trade, I put an I here. This is previously high. I asked people, what do you see? I like interacting with my community, and this was the USDCAD trade I took that day, and I lost it. I posted it. Transparency. And this was the gold trade I took that same day, and I posted it too, and people ate with me. This is a PNL, right? Transparency. You should be in this channel. So here we have come to the end of this video. And if you want to join the mentorship, the first link in the description, okay, the first link in the description is my DM. Do well to send me that DM. Send Forex, okay? When you send Forex, I'll tell you the requirements to join the mentorship, and you can learn this easily with more guidance, more examples, and also you learn my entry model so you can be able to trade towards the right draw every single day and get your daily buyouts. See you guys in the next video. Do well to watch this video coming up. It's going to really enhance your trading perspective. Peace.